We're talking about tech companies and tech startups. The thing that is very important for tech companies is valuations. Evaluation is how much the company is worth, and the way these companies come up with their valuation is by looking at how many users they have. So they take a look at how many users they have, and then they apply a multiple to these users. Maybe they say each user is worth $20. Or maybe each user is worth $100, or maybe each user is worth $500, and then they take the number of users, multiply it by the number, and that's how they get this value. So tech companies have been really great up until the early part of 2022 because, well, there's a lot of cheap money floating around. You had low interest rates, you had a lot of people with cash, maybe people got bailouts or stimulus checks, companies got bailouts, so there's a lot of money, dollars floating around, and they were looking for a place to put it. Well, if we focus in on kind of what we saw happen in 2020 and 2021, the world moved more and more digital. And so people were really excited about this tech movement and this digital movement, and a lot of money flowed into these tech stocks because everybody was spending more time on the internet and the world is moving more and more digital. That's just the way it is. I mean, Amazon is the world's leading retailer. Anybody who wants to buy something on the internet is going to go to Amazon to buy it because Amazon is so efficient, Amazon makes it so easy, and Amazon Prime makes it deliver so fast to your house. So when you're in an environment where you have low interest rates, you have high inflation, the value of your dollar is going down, nobody wants to hold on to dollars. Nobody wants to save dollars, and nobody wants to invest into a company that has a smart savings plan that is making dollars. They want to invest in a company that could see a lot of potential growth because that's the only way that they can combat inflation, by taking on the higher risk and trying to see the higher growth with their money. And so now they're investing into companies, which is driving up the valuation of these tech stocks, which brings me to the topic of value and valuations, because at the end of the day, when you are investing into a stock, you're not just investing into a ticker symbol. Like when you invest in Amazon, you're not investing in AMZN, you're investing in the Amazon Corporation. You're investing in the infrastructure that Amazon has built, you're investing into the warehouses that Amazon has built, you're investing into the real estate that they own, you're investing into the employees that they have trained, you're investing into all of that. That's what you're investing in. You're not just buying a ticker symbol, and that's what a lot of people assume that they're doing when they're trading stocks, because they're trying to find something hot. They don't know what they're buying. They just want to ride the momentum, they want to ride the wave and hopefully see a quick return. That way they can cash out for a profit. And you really start to see that shift when you see interest rates go up, because as interest rates go up, that's when investors want a bigger safe haven for their money, and they want to put their money where they can see more security, more stability, and real value. So now let's talk about how to value a company, because we talked about one way to value it. You can look at the number of users, multiply it by whatever dollar amount you want, which gives you a value. But a second, more kind of fundamental way of valuing a company is by looking at how much cash a company is making. So if I own a company, I started a company, and let's assume this company makes $1 million. How much is my company worth? Well, it depends what my company does. If it's a tech company, it's going to be worth more than if it's a retail company where I just sell clothes. So this is where you have to create the right valuation for how much this $1 million with the cash flow of profit that it's worth. Because if I were to sell this company, someone else, the investor, is going to want to put a price on the company. Some people might say, okay, well, this company is worth $10 million. That's a 10x multiple, which means $10 million. Others might say it's worth $30 million, depending on what type of revenue I'm getting, and others might say it's worth $100 million. So this is where now you have to come up with the right valuation and the right multiple for your company. A $1 million cash flow at a 100 multiple is worth $100 million. At a 30 multiple, it's 30 million. At a 10 multiple, it is $10 million. And so what we saw happen, especially in the tech boom that we saw in 2021, is tech companies saw insane valuations. They were seeing valuations at higher than 100 times earnings in some cases, meaning for every dollar that you earned, the valuation of a company went up by $100. This is, I mean, if you think about this financially, kind of hard to retrieve your money in this case unless you have significantly high growth here, because if I have to pay $100 million to make $1 million, well, it's going to take me 100 years to make my money back at this rate. You can make the number smaller to make it even more relatable. If somebody is making $1,000, you go out and you start a company, a lemonade stand, and you're making $1,000 in a year. Well, based off of the 100 multiple, you can sell that lemonade stand for 100 grand because over the year you made $1,000. You made less than $100 a month, and you can take this company that's making less than $100 a month and sell it for 100 grand. See, when you start to put it like that, you can kind of see how absurd those valuations start to become. But the reason people have been buying in to these 100x multiples, or maybe even more than 100x multiples, is because they were hoping for fast growth here. They're hoping that they're going to turn this $1 million worth of cash flow to $2 million or $4 million or $10 million sometime in the near future. So people have been speculating because these tech companies were also able to borrow money super cheap. You can go out and borrow money for very low interest rates because mortgage rates, interest rates are at historical lows. This is one of the things that Warren Buffett looks at. He looks at the valuations of companies, he looks at the cash flows, and then he multiplies it by a number, and that's how you come up with the valuation of a company. And they have created something called a Buffett indicator, which kind of looks at the valuation of companies. And what we saw is that the Buffett indicator said that the stock market is more overvalued than ever. Business Insider says that Warren Buffett's go-to market gauge hit 211%, signaling that stocks are very expensive, they're overvalued, and that might mean a crash is coming. Yahoo Finance says that Warren Buffett's favorite stock market indicator still screams sell. The Buffett indicator focuses here on valuations of companies relative to how much money a company is making. This is what Warren Buffett likes to look at. He likes to look at the fundamentals of a company, and for him, it has worked over the long term. Well, in the short term, you can see major swings, where companies that are not making that much money could be valued insanely high because investors are speculating and hoping that this company will blow up sometime in the near future. Now, you can be right, or you can also be wrong. It's much easier to do that when interest rates are low because you have a lot of dollars floating around, and these companies can borrow a whole bunch of money to try to accelerate their growth. But as you start to enter a time where interest rates start to rise, well, that's when more and more investors want to see this growth, not just the multiples of your company growth. This is one of the reasons why you're seeing a lot of hedge funds on Wall Street selling out of these tech stocks, these high valuation tech stocks, and they're rotating the money into lower valuation value stocks because they know that these value stocks are producing solid cash flows. They know that they'll be growing slowly, while tech stocks, they've been growing quickly in the past, but now that it's going to become more expensive to borrow money, and now that their debt is going to become a whole lot more expensive, they don't think that tech stocks are going to be able to grow as fast in the near future. That's why you're seeing that shift, and that's why you've been seeing a lot of tech stocks get hit hard because hedge funds are worried about that. Now, before you go out and sell all of your tech stocks, I need you to take a step back, take a deep breath. Now, think about what your goals are. Are you trying to be an investor or are you trying to be a trader? Because investors and traders have two completely different goals and two completely different mindsets. I'm an investor. I don't trade. When I buy a stock, I don't care what happens in the next 6 months or even the next 12 months. I want to hold on to it for the long term because I'm investing in a company that I believe in and something that I want to own for the long term. Thank you for watching. If you enjoyed the shorter clip from the longer videos, here's another clip that I think you'll love. And if you're interested in learning more about how to invest your money in the stock market, our team put together an amazing guide that will walk you through how to invest your money in the stock market. This guide is completely free when you sign up for our daily newsletter. So if you want to read this guide, all you got to do is click that button right over there. Thank you for watching, and as always, keep hustling.